Now let's talk about the last Greek. This one is Rho. Rho represents a change in the option price for 1% increase in interest rates. So even though interest rates are rising right now at the time of this recording, and there's a lot of fear with interest rates, Rho really doesn't impact option prices, at least the way we trade it. Because all of our contracts are expiring within 45 days, maybe even up to 60 days, they don't really have an impact. However, if you're trading very long dated options, they may have an impact. So let's take a look. Again, Rho really doesn't have much of an impact. So let's take a look at this right here. So if interest rates rise, and because these are puts, it means that these option prices are going to lose this much value. So you'll notice Rho really doesn't have that much of an impact. Look how large these numbers are for the other Greeks, and then Rho it's a lot smaller. You'll also notice Rho for put options are negative. This means for each 1% increase in interest rates, the option price is going to lose by this much, assuming all else equal. Now let's look at Rho on the call side. For each 1% increase in interest rates, the call options are actually going to become more valuable, but such a small amount compared to all these other Greeks. That's because it's a short-term option expiring next week. Now let's look at something that expires in a few months. You'll notice how Rho has a lot bigger impact. For the put options here, it's a larger negative number. And the call options here, it's a larger positive number than the shorter dated options. Again, if you're trading options that are longer term in nature, Rho may have an impact, but because we trade shorter term options, Rho really doesn't have much of an impact. So basically that was a very high level basics of the Greeks. So let's do a really quick recap. The Greeks are used to price options. Example, how do we get this price right here? It's because of the Greeks. These are used as inputs, all except Vega are used as inputs to price these options. Now these prices are arriving because of the Greeks. And there are 5 Greeks which determine the option prices. They're delta, which is how much does an option price change for each $1 increase in stock price. We have gamma, it says how much does delta change for each $1 increase in stock price. We have theta, which is time decay. So how much does the option lose value each day? We have vega, which stands for implied volatility, is how much does an option's price change for each 1% increase in implied volatility. And lastly, we have rho, which is how much does an option's price change for each 1% increase in interest rates. So a good way to remember all of it is delta usually means change in gamma. Gamma, you just have to remember this is a derivative of delta. Theta, it's time decay. So T and T, time decay. Vega, implied volatility. They both start with V. And then rho, these are rates, interest rates. Starts with that. Awesome. Again, this was a high level overview of the Greeks. As we start getting into more of the trading strategies, we'll understand why these are so important. Great, I'll see you at the next section.